If you are new to gold investing, these are the 5 things the financial media will never explain clearly. And I'm not talking about vague tips like gold is a safe haven or buy gold when you're scared. I mean the actual mechanics, the numbers behind the numbers, and the mistakes that cost beginners real money before they even get started. Gold is sitting at $4,121.80 an ounce right now. That is an all-time high territory. And if you have no idea whether that means you should buy, wait, or run, this video is specifically for you. Stick around, because by the end you will have a starter framework that most people spend years trying to piece together. Let's start with the first thing the media glosses over: why gold holds value at all. Because here is the thing, gold does not pay a dividend. It does not generate revenue. A bar of gold sitting in a vault is the same bar of gold 100 years later. So why does anyone want it? The answer comes down to scarcity and trust. All the gold ever mined in human history would fill roughly 3.5 Olympic swimming pools. That's it. The entire above-ground supply of gold fits in a cube about 22 meters on each side. You cannot print more of it. You cannot manufacture it cheaply. And that scarcity is what gives it staying power that paper currencies simply do not have. Here is the practical implication for you. Gold is not an investment in the traditional sense. It is monetary insurance. When the US CPI index, which measures the cost of living, sits at 333.979, that means prices are roughly 3.3 times higher than they were in 1982. Your dollars are shrinking. Gold's job is to shrink with them, or more often, outpace them. If you buy gold, you are not trying to get rich. You are trying to stay even against a system that is working against your savings. Now, the second thing, how is gold actually priced? Here is something most people never think to ask: who actually sets the gold price each day? The answer is stranger than you expect. The London Bullion Market Association runs what is called the LBMA Gold Price, an electronic auction that happens twice a day in London. A handful of major banks sit in that room, and between them they move the price for the entire world. But here is what they do not tell you: the vast majority of gold trading is not physical gold at all. It is paper contracts, meaning promises to deliver gold, traded on exchanges like COMEX in New York. Some analysts estimate that for every 1 ounce of physical gold in the system, there are somewhere between 100 and 500 paper ounces being traded against it. That is a fractional reserve system for gold, just like banking. Why does this matter for you? Because it means the spot price you see, $4,121.80 an ounce today, is largely set by paper market activity, not by physical supply and demand alone. In a genuine financial crisis, when everyone demands physical delivery at once, that paper system could buckle, and physical gold could trade at a significant premium to the paper price. So the price you see on your screen is the paper price, not necessarily the real-world price of metal in your hand. Third thing, what actually moves the gold price? This is where most beginner content gets lazy and just says fear and uncertainty. That is not wrong, but it is nowhere near complete. The single most powerful driver of gold is real interest rates, meaning interest rates minus inflation. When real rates are negative, gold tends to surge because holding cash is literally costing you money. When real rates are high and positive, gold struggles because you can earn real returns just by sitting in treasuries. Right now the federal funds rate is 3.63%. US real GDP growth is 2.1%. And inflation is still running well above the Fed's 2% target in many categories. That means real returns on cash are razor thin for ordinary savers. That is fundamentally bullish for gold. But here is the surprising part: gold is at $4,121.80 an ounce even as rates are still relatively elevated. That tells you something important. The market is not just pricing in today's rate environment. It is pricing in fear that the Fed will eventually lose control, that debt levels are unsustainable, and that the dollar's dominance is being quietly questioned by central banks around the world. Central banks bought over 1,000 tons of gold in each of the last 3 consecutive years. They are not buying because they saw a YouTube video. They are buying because they see what is coming. Practical implication: when you hear the Fed raise or cut rates, do not just look at the headline number. Ask yourself, are real rates going up or down? That is the signal that matters for your gold position. Fourth thing, and this is the one that trips up almost every beginner: how do you actually buy gold? Because there are at least 4 totally different ways to do it, and they carry completely different risks. Option 1 is a gold ETF, like GLD or IAU. You buy shares through your brokerage, it tracks the gold price, and you never touch physical metal. It is liquid, it is easy, but here is the catch: you do not own gold. You own a share in a fund that claims to hold gold. In a systemic crisis, that distinction could matter enormously. Option 2 is physical gold, meaning coins or bars you hold yourself or store in a vault. The US Mint's Gold Eagle coins and the Canadian Maple Leaf are among the most recognizable and tradable. Physical gold carries a premium over spot, usually between 3% and 8% for coins, sometimes higher for small bars. That premium is the price of certainty. You know exactly what you have. Option 3 is a gold mining stock. This is where a lot of beginners go wrong. Mining stocks are not gold. They are leveraged bets on gold prices filtered through management quality, geopolitical risk, energy costs, and about 50 other variables. A mining stock can fall 40% even when gold rises, if costs spike or a mine floods. In a bull market, miners can outperform gold by 300% or more. In a bad environment, they can wipe out. This is high risk, high reward, not a gold substitute. Option 4 is a gold streaming or royalty company. These are businesses that finance mines in exchange for the right to buy gold at a fixed low price forever. Here is why royalty companies are different. They collect gold revenue without ever swinging a pickaxe. No fuel costs, no labor strikes, no flooded shafts. Many long-term gold investors consider royalty companies the smartest equity play in the entire sector. That is a name worth researching once you have the basics down. Practical implication: for a true beginner, start with a small allocation to a gold ETF to get price exposure this week, then work toward owning some physical metal as your emergency monetary insurance. Do not touch miners until you understand the individual company. Fifth thing, and maybe the most important, the common mistakes beginners make. Number 1 is buying all at once at an all-time high because of fear of missing out. Gold at $4,121.80 an ounce feels urgent. But historically, dollar cost averaging, meaning buying a fixed dollar amount on a regular schedule regardless of price, produces better long-term outcomes than trying to time the top or the bottom. Mistake number 2 is ignoring storage and insurance costs on physical gold. A home safe that is not bolted down is not security. Proper vault storage runs roughly 0.1% to 0.5% per year of your gold's value. That cost needs to be in your calculation. Mistake number 3 is putting too much in. Most serious financial planners suggest gold should be between 5% and 15% of a diversified portfolio. It is an anchor, not an engine. If gold is 50% of everything you own, you are not hedging, you are speculating. Mistake number 4 is selling in a panic when gold drops 10% or 15% temporarily. Gold fell over 40% between 2011 and 2015 before recovering and surging to new highs. If you bought and held through that entire period, you are sitting on extraordinary gains today. Volatility is not a flaw in gold. It is the price of admission. Here is your starter framework. Pick a target allocation, say 10% of your savings. Start with a gold ETF to get exposure this week. Set a recurring monthly purchase, even if it is just $50 or $100. Research one reputable physical coin dealer in your country and plan your first physical purchase when you hit a meaningful dollar amount. Watch real interest rates, not just the Fed headline rate. And come back here every day, because this channel covers gold and macro finance with the depth and the specific numbers that you will not find anywhere else for free. Subscribe right now and you will get a daily breakdown of what is moving gold, what the central banks are doing, and exactly what it means for someone managing their own savings. Not headlines, not hype, real numbers, real analysis, built for people who want to understand this market, not just react to it.